Hello traders and welcome back to the new video of Nova Forex. Are you also facing this issue wherein you initiate your long or short trade and after that the market goes into the opposite direction of your trade? If this happens with you too, then don't worry, this video has got a solution of it which would help you to resolve this issue. But before we get into the video, if you are interested in the topics like this, then like the video and be sure to subscribe the channel along with hitting this bell icon to never miss out any of upcoming content. In this video, we would discuss about how the big players trap you, and then we would share the best pullback trading strategy. Now let us begin with learning how the big players trap you into the market. As we all know that the market is unpredictable, because there are so many institutions, banks, hedge funds, and individual traders participating in the market. Each of them has its own thoughts and methods. We cannot know what others are thinking about the same candlestick that you are witnessing, and which is why each time in market is unique and nothing is to be known for sure. And this is why the confirmation is crucial, especially when taking trades during the pullback of it. It's important to be flexible when trading, so you should keep your mind open to market movements. Sometimes the candlesticks may move in accordance with your analysis and expectations, but in other circumstances, their movements may cause confusion. This happens because there are a large number of participants and you cannot know what others are thinking. Price level that you think is a high may seem a low in others' eye. Like in this case, the market is going through an uptrend phase. A massive move has been created by the market, and after that the market made small bearish candles. By seeing this, some of the participants would go short from this point as they believe that the price has become expensive and hence, a correction move would start soon. But what did the market do? It continued going above, which remove all the sellers from the market. The flexibility when trading is highly important as it puts you in the best position to discover potential opportunities when it comes. Additionally, this also helps to relieve you from negative feelings or psychological shock when things don't go according to your expectations. Now let us learn about pullbacks. A pullback is basically a pause into a current trend of the market which is created by the short-term traders. The pullback is too much beneficial for those who wants to initiate their trade according to the ongoing trend. Like during an uptrend, when the price makes a pullback, a lot of buyers would enter because they are getting it at a lower price. The individual traders mostly uses the tools like support and resistance, supply and demand zones, trend lines, and many more. Due to these tools, they may end up making profits into the market, but not every time. Like in this example, we can see that the market is in an uptrend. The market is moving between this range. The market has respected this support level multiple times, and hence, a lot of traders would keep their buy limit orders at this level of support. But the market did not respect this level this time. The market has made this bearish impulsive move. Now the market has again came to this level. A lot of traders would consider this as a retest and would go short from this point. But the market reacted in the opposite way by going above instead of going to downside. Now let us find out why the market reacted in this manner. Let us switch over to the higher time frame and analyze the chart of the market. So, at this higher time frame, the market is seen making an order block zone below the support zone. And this move by the market trapped many traders, which resulted into significant losses for them. The small pullback in the higher time frame may seem like a reversal into the lower time frame. The scalpers and intraday traders usually gets trapped into the market as they use only lower time frames to trade into the market. And thus, using the higher time frame analysis in your trading plan is a wise decision. The higher time frame analysis is one way of saving from the traps and finding such good trades. Another way of it is using the 50-day moving average in Confluence with these tools. A lot of individual traders use the 50-day moving average for knowing the current trend of the market. Like if the market is above it, then it is an uptrend, and similarly, when the market is below it, it is a downtrend. Using it in this way is a bad idea as it leads to significant losses at time. The correct way to use it is during the time of entries into the market. The 50-period exponential moving average provides a dynamic support to the market, which is why going long or short into the market is a wise thing. So, here we can see that the market went a little below the 50-period line and then it started going above. The 50-period exponential moving average line guides us in initiating long or short trades into the market. Like when the market makes the pullback, a lot of traders gets confused that from which point should we enter into the market. At such a situation, the moving average would help us in knowing when and at which side into the market should we enter. For this reason, We recommend you using these tools along with the confluence of either higher time frame analysis or moving average. The moving average and higher time frame analysis gives us a confirmation of the end of the pullback during the trending markets. And also, by using the moving averages and higher time frame analysis in your trading plan, you would be saved from entering during the fake breakouts. Let us learn through an example that how the confluence of higher time frame analysis and moving averages would help us during the fake breakouts. Here we have the gold chart on the daily time frame. The market is in the uptrend phase as it is making higher highs and higher lows. The market is moving between this range. There are heavy selling orders which are rested on this resistance zone. Now the market is seen coming back to this resistance zone. But this time the market didn't respect the resistance zone as the price went above it. Now there are two possibilities at this point. The first possibility is that this is a fake breakout, and another possibility is that the buyers have increased into the market and hence this is a sign of bullish breakout. Now here is where a lot of traders gets confused into the market. In order to clear this confusion, we would go on to the higher time frame to check if the market has made any key levels like supply zone above this resistance zone or not. If the market would have made supply zone above this resistance zone into the higher time frame, then we would not go long from this point as the market would fall soon. And instead of going long from this point, we would go short from the supply zone level. After going on the higher time frame, we can conclude that there is no supply zone being formed previously above the current market level. And the market is making fresh highs currently. And also, the price went above the exponential moving average line during the breakout phase, which signals that there is a lot of buying pressure into the market. A lot of individual traders as well as small institutions waits for the market to reach at this exponential moving average for going long into the market. This is because they believe that whenever the market reaches at this EMA line, the price would go up again. This thing might be true sometimes but not every time. Like during a strong bullish trending market, the price would not even come close to this EMA line as there is high buying pressure into the market. And similarly, during the strong bearish trending market also, the price would not come close to this EMA line. We would go long from this point. The risk-to-reward ratio of our trade would be 3:1. The market went above, which is why we earned nice profits from this trade. Now let us move on to the pullback strategy. So, in this strategy we would use market structure in Confluence with the exponential moving averages. And only at the time of taking entry into the market, we would use the multi-time frame analysis. Let us understand the strategy properly through an example. So here we have the Euro-Pound chart on the daily time frame. The market is moving between this range and is currently into the consolidation phase. We have taken the 21-period exponential moving average on our chart. Our goal with this strategy is to enter when the consolidation phase ends and the trending phase starts. The market has made a breakout at this point. Now we would wait for the market to make a pullback till this level for going long into the market. The market made an impulse move to the upside and hence we would wait for the market to make a correction move. The market is making the pullback and during it, the market has reached at this 21 EMA line. Currently, the market has reached to this flip zone area. After seeing this, we can consider this area as the area of confluence. We would consider going long from this zone as this area has higher chances of getting respected. We would place our buy trade from this point. The stop loss of our trade would remain below the resistance turn support zone and the target would be 3 times its stop loss. This is where we end our video. So, in this video we share the best pullback strategy which would help you into making your trades profitable. Now before we end our video, be sure to subscribe the channel and hit this bell icon to never miss out any of our upcoming videos.